All right, let's bring in our first guest this morning, Detlef Glow, head of Lipper EMEA Research, Refinitiv. Great to have you on the program. Last week, I think fair to say that the main event for investors was Federal Reserve Chair Jerome Powell's speech at Jackson Hole on Friday. I'm curious from a fund flow perspective how bond market flows have evolved around that Fed speech.
Yeah, good morning. Thanks for having me. Unfortunately, in Europe, the fund flows are only reported on a monthly basis. This is different to other markets around the world. But I can tell you that investors were in a good mood with regards to bonds, since they bought 23.2 billion in bond funds over the course of July, anticipating obviously that something is happening in August. And also we see the year-to-date flows at 112 billion for the year.
Looking at, I guess, financial markets overall, you've got insight into bond markets as well as equity markets and other asset classes. How would you describe overall investor sentiment at the moment?
Well, you see there are two streams at the moment. If you look on the overall flows here today, you see that investors in Europe are clearly in a risk-on mode, as the majority of their investments went into equities, bonds, and mixed assets. If you look on the short term, you see that they are somewhat risk cautious because they bought money market euro for 43.3 billion euros. On the other hand side, they were selling off money market US dollars and bond global corporates, as well as bond US dollars and bond emerging markets, and bringing money somewhat back to Europe, i.e. to money market euro, money market GBP, bond global euro, and bond global short terms.
Well, right now, interestingly, from a pandemic perspective, Europe is actually getting a lot of positive attention for the way the vaccination rollout is going and the impact that's had on case numbers, certainly relative to the U.S. Has that begun to show up in investor flows into the region?
I don't think so. As you see that European investors are really looking for diversification in their portfolios. So they are buying equity global, mixed assets, flexible global, mixed asset balance global. And if they want to have a closer exposure, they are going to the information technology sector, as you see that there's some outperformance coming from technology stocks last year and also this year.
Well, I was just reading some interesting research coming that was highlighted by the Financial Times this morning, talking about corporate debt and how it's been higher than ever in terms of absolute terms as well as relative to GDP. But it sounds as though that's not deterring investors from getting involved in bond markets. Is that fair to say?
That's really fair to say. If you look on the flows, actually, the year-to-date flows in bond global corporates are outflows. What you saw over the past few years and months, that there is a strong demand for corporate bonds, as they are paying higher interest rates than government bonds, and you don't want to be in a bond that pays you zero interest rate, right?